Over the past couple of years, we've seen housing prices grow significantly. The inventory of available homes to buyers has been low, and we've heard many stories of bidding wars with properties selling for well above the asking price and appraised value. Low interest rates combined with low inventory gave home sellers an advantage, or what is referred to as a seller's market. It was just several months ago that mortgage rates were in the high 2s to low 3% range. Now mortgage rates are hovering between the high 5s and over 6% on any given day. The increase in interest rates is a direct impact to borrowers. For example, the payment on a $250,000 30-year mortgage at 3% is about $1,054 a month principal and interest. If the rates were to move to 6%, the payment on the same loan amount would be $1,500, or almost $445 greater. For many, higher rates mean that your affordability just decreased, or the amount of money you're qualified to borrow is lower today due to the higher rate. While this may seem extremely frustrating, let's talk about the relationship of housing prices to interest rates. Low interest rates typically increase the demand for property, driving up real estate prices. That's exactly what we've been seeing in the markets across the country. While you're paying a low interest rate, you are paying a higher sales price for the property you're purchasing. A surge in mortgage rates will typically start to slow down home appreciation as many potential buyers are priced out of the market. Eventually, demand for housing will cool and inventory of available houses to buyers will be greater than what it is today. If the inventory shift to the point where they exceed demand, then sellers will be more inclined to negotiate price with the buyer. This is what we refer to as a buyer's market. Housing prices are typically within a reasonable range of the appraised value. As housing prices cool, a house that is for sale today at $400,000 could decline, for example, to $325,000 due to market conditions. Nobody likes to be in a situation where they bought a house for $400,000 and a couple of years later that declines significantly to the point where in some cases you owe more than it's worth. So is the glass half full or half empty? If I buy a house at the high point, I've already paid the higher price and I can't do anything about that. My opinion is that I'd rather pay a higher mortgage rate and buy a house at a lower price. The reason for my opinion is that I can refinance my mortgage when rates go down, and I'll have the best of both worlds. A house that I bought at the initial lower price point and a mortgage at a now reduced price point. Nobody knows for certain how long rates will stay high or when they'll start to go back down. Nobody knows for sure the exact timing on when housing prices will cool. This video is meant to provide some information to consider for borrowers that are frustrated with a quick increase in mortgage rates. If we can be of any assistance to you, please reach out to us and our mortgage originators will be happy to speak to you. Our next video will be on fixed rate versus adjustable rate mortgages. We'll talk about the advantages and disadvantages of both.